was highly leveraged. 10% down and you're in the stock market. Anybody, got $100 from, you saved up from shoe shining, you can go into the market, okay? Now part of the leverage was that you had these mortgages which were themselves no money down, that's infinite leverage, okay? But they would go into CMOs, which were leveraged, and they would be sliced into tranches and sold to maybe CDOs, which were leveraged, which would be sold to CDOs, which were leveraged, but guaranteed by a CDS, a credit default swap, which now, Lord knows how much leverage there is in them. So not only was there leverage, but there was obscurity in the current situation. I had dinner, I had a meeting in my office, and then we had dinner with the families of a guy who was the head of the information technology in one of the big players in this space. And he said they were told to, when things were falling apart, around them, they were told to value these pieces of paper. Well, they knew what went in directly, but immediately, but they didn't know what went into the stuff that went into the stuff that went into the stuff. So, so we have to somehow spend a little money, a few million if necessary, to try to clarify what is the direct and indirect exposures of these pieces of paper. This is a very small expenditures compared to the billions, that are being spent to try to put out the fire. But unless we get some clarity, whether these things end up in the public hands or private hands, unless we have some clarity of what's the direct and indirect exposure, nobody will ever be able to value these things. We'll never be able to get out of this mess. How long can you be in a mess? How long, we'll edit that hump out. It's hard to get good help these days. Anyway, let's talk about Japan for the moment. They were in a mess for a decade. Why? Because the banks had on their books companies which were, dead, zombies. They were walking dead, and they couldn't recognize that they were really bankrupt because then the banks would be bankrupt. And the Minister of Finance said, "That's okay. We know everybody knows what you're doing. I mean, they know in the States, they know in Japan. We all know what you're doing, but you're nice guys, and we don't make nice guys suffer, even if we do drag this out for a decade." I think about it, the original Paulson plan, the $700 billion that was going to bail out the Paulson's friends directly. It was a little bit like the Minister of Finance saying, "You guys are nice guys, my friends, we can't let you go." But there was such a howl, about that they backed off, and they're using the money in, other ways. So I think I should cut. I've just gone and gone. Yeah, okay. I figured, just keep going. Somebody else.
He brought lots of tape.
Yeah, he bought lots of tape, and there's an edit, and they cut the tape.
That's right. So you talked a little bit about portfolio insurance and sort of establishing a floor at which it starts to sell.
I'm sorry. You established a floor.
Sorry.
And you sold as you went down towards the floor, so you would never go below the floor.
Right. So you
in theory.
Right. So you
in theory.
A floor at which it's never going to get that back.
Absolutely.
And BGI was one of the bigger players in this.
Right.
Oh, were they?
So I think that leads really well into our next question, which is, when should investors reevaluate their market or investment assumptions? Is now a good time to do that? I mean.
Okay. Now the question isn't on the tape, so let me think about whether I have to repeat the question. Okay. Okay. Now, we know that there's a questioner, so I can say that's a good question.
Yeah, I think we're gonna think about that after the fact, but however.
Yeah. However you feel comfortable.
Okay.
And let's give it a pause.
So when should investors reevaluate their assumptions or evaluate their choice given their assumptions? Now,
I'm sorry, could you repeat? I was trying to shift the camera a little and I bumped it, but it was a great opening.
Okay, great.
You repeated the question really
nicely. Right.
So when you're ready.
I could never do the same thing twice. I'll never be an actor. Yeah. So the question is, when should investors reevaluate their assumptions, or when should they reevaluate their decisions, their strategies, given their assumptions? Well, they should reevaluate their assumptions if there's new information. Now, we at Guided Choice, we fit our models, our capital asset assumptions, basically to data that goes back to 1926, this Ibbotson data that goes back to 1926. That doesn't mean that we assume that what's happened on the average in the past is what's going to happen in the future, because as Rob Arnott and Peter Bernstein pointed out in a recent article, there's been a great increase of valuations, a great increase in the price-earning ratio since 26 to the present. And unless you expect a similar increase in valuations from now to 20 years from now, on a forward-looking basis, you should not estimate that the expected return going forward is necessarily the average looking back. But we do use long series. Now, of course, some asset classes don't have data going as far back, and so we do statistical adjustments and so on, taking into account. And then we now this series from 1926 to the present is not much longer now than it was at the end of September. I mean, there is a big October surprise, not surprise, but an October event in there. But mostly, we look at annual returns. I mean, we do have a monthly model, but what am I trying to say? I'm trying to say that data-wise, there isn't a lot new that's happened recently. It's true that we've had a horrible event, but it isn't the first horrible event, and it isn't the most horrible event. It turns out that if the year, I mostly think in terms of yearly returns. I think as a first approximation for somebody who is not a professional in this business, they should say to themselves, every year nature pulls a random number from a bushel basket that has been the same since 1926. And this particular year, if the year ended right now, this year would be a little over a 2 standard deviation downtick. That's not the only over 2 standard deviation downtick we've ever seen. And in fact, if it was a bell-shaped normal distribution, Gaussian distribution, you'd expect downticks exceeding 2 standard deviations to happen with 2.5% probability, 2.5% probability, once in every 40 years. You know, you do this for 100 years, and you got to expect, 2.5 years that look like this. So one of the things we try to do in Guided Choice is to help the client, the participant, understand that there's randomness, and there are good years and there's bad years. We try to get them into a risk class, a portfolio whose risk class is suitable to them in the sense that they're not going to chicken out from the program or shift their risk class terribly when a 2 standard deviation event happens or a 2.5 standard deviation event happens. We have these 7 risk classes. We have 7 portfolios off the what everybody calls now the efficient frontier, the risk-return trade-off curve. 7 is the most risky. 1 is the least risky. We do Monte Carlo simulations to show people what assuming that the distributions will be similar in the future as they were in the past, show people what the probability distribution is of, or at least a few points off the probability distribution of what you may have when you retire, or more specifically, what you will be reasonably able to spend when you retire. If your retirement is 17 years from now and you save at a certain rate and you start with a certain assets and your employer matches or doesn't match at a certain rate, etc. And so they get this idea that there is a probability distribution, and people are shocked to find that there's a 1 chance in 20 that they may have a lot less than they thought they would have, and after the shock, what they usually do is decide they have to save more. But it means that when one of these events happens, if we have done a good job of educating them as to the process, this random process that is the stock market, then they will sort of stay put with their allocation, with their choice. 2 or 3 weeks ago, 4 weeks ago maybe now, I wrote a piece for Guided Choice, which they distributed, I don't know, either under my name or their name or something like that, but it was for them, for the participants. And it said, the title was, "The Sky is Falling, What Do I Do Now?" And this story said, the advice said, well, it depends on what risk class you're in. I turned you off, you stupid bastard.
Make sure that
And that's my office. That's Midge. Let me start back, not all the way to the back, but I wrote this piece called "The Sky is Falling, What Do I Do Now?" And it depends on what risk class you're in. If you're in risk class 6 or 7, like 7 is all equity, and not only is all equity, it's got a little chunk of emerging market in it and so on. It's for the guys who say, look, I got 30 years to go and I got a good job and I want to plunge, But now that you've experienced what a 2 to 2.5 standard deviation move is in real time, maybe you'd like to come down to risk class 4 or 5. Now, if you're in, but if you do come down to risk class 4 or 5, don't say, well, I'm going to come down now to risk class 4 or 5, but when things get good, I'm going to go back to 6 or 7. Because you will do what, on the average, active small investors do. You will buy when things are high and you think they're going to go up, and you will sell when things are low and you think you're going to go low. And you will just not do as well, anywhere as well, as just holding. Just let us rebalance once in a while for you and just hold. Stay with your risk class 4 or 5. Now, if you're risk class 2 or 3, well, okay, so you're smirking. Try not to gloat in the presence of, of your colleagues. Risk class 1, you're probably in trouble and you don't understand it. We didn't do a good job of educating you because it's like my eye doctor of many years ago who said he had a problem. He had all his money in CDs, certificates of deposits, and at that time the interest rate went way down, and he's making no money on his investment. What is he going to do? Well, somehow going all the way down to just certificates of deposits or money market funds or something like that is not really safe. There's something called inflation. It's a little bit like the Jewish mother that said to her pilot son, play it safe, fly low and slow. That just isn't the way to play safe in this world. So the general advice is relax. What you should, I know there may be a problem and you should be aware, but you should approach the situation with the following, kind of calmness. Mission control, we have a problem. Thank you.
So it's interesting hearing the kind of advice that you give to DC plan participants. Do you think on the defined benefit side, do you think defined benefit plan sponsors will react to the current situation any more prudently than defined contribution plan participants? Or do they fall prey to the same knee-jerk reaction, which is I've got to get out, and then I end up, selling low and buying high?
defined benefit plan sponsors are human beings, just like defined contribution participants are human beings. And some are smarter, and some are dumber, and some are more disciplined, and some are less disciplined. Like when it comes to good, sound advice, don't ask me, ask David Swenson, who is the CIO of Yale University. And he's been using portfolio theory at an asset class level like we recommend, except his asset classes at the time were quite different than everybody else's asset classes. Now, he's been so successful over the years that everybody wants to do it like Yale or Harvard. There are a lot of advisors out. The big pension plans look to places like Wilshire and Russell and Callan, and these, by and large, are savvy, and they have on, they listen to Bill Sharp and me and so on, and the notion of, cool it, don't take the steering wheel and go this way, this way, this way. They understand. But there's others that, there was this guy in Orange County who stuck his neck way out because the Merrill Lynch chief economist told him the interest rates would go this way or that way, and he leveraged, leveraged is a bad word. Leverage is, see, you might ask you might perhaps ask the question, what is the role of leverage for the defined benefit or the defined contribution plan? And I say the role of leverage is zero, absolutely zero. If somebody puts their defined contribution or defined benefit plan into, let's say, a 60-40 mix, that's nice and conservative. 70-30 mix, well, it's a little bit more spicy. 80-20 mix, yeah, well, okay, I don't think so. Well, if you're young and it's an individual and I got a long time to go, maybe that's okay too. But if somebody says, how about a 150 versus, and a minus 50, you're sticking your neck out. And that's hubris. Let me tell you the history of financial hubris. I'm a Nobel laureate. Now, I have two friends who are also Nobel laureates. Now, Bob Merton is one of the smartest, nicest guys you'll ever find, and Myron Scholes is not a slouch either. And now, of course, they were part of long-term capital management. Now, what did they do wrong? First, they leveraged terribly. I must say, I've heard David Modeste described what they were doing, and they were using portfolio theory. They were doing, historical covariances and even upping them and so on and so forth. And so, I should be embarrassed that they were using mean variance among other things, and they got into trouble. But there was a couple of things I wouldn't do, and I certainly wouldn't recommend any of our clients, and we certainly do not recommend any of our clients doing this. One thing was they were, as I said before, highly leveraged, many to one. There's a little lesson that's a little too technical for me to do it here, but it's the difference between the geometric mean and the arithmetic mean. The arithmetic mean is an ordinary average. The geometric mean is what you get in the long run. And roughly, geometric mean is equal to arithmetic mean minus 1/2 variance. Variance is volatility squared, not just volatility, but volatility squared. So if you leverage, first, your arithmetic mean goes up proportionately. Your variance, and remember, you're subtracting variance, it goes up by the square. So geometric mean, first it goes up, and then it comes down. And by the time you've got leverage like 2 or 3 or 4, you're hitting sort of maximum geometric mean. And you get to 10, you're going into negative geometric mean. You go to 20 or 30 or 40, you are negative geometric mean. That's not even considering that you're mark to market and you can get wiped out in a day, even if you were not. So they were just leveraged too much. Then the second thing was they were using historical covariances. And again, we look at, we should look on a forward-looking basis. You know, I said before that when we estimate expected returns for a asset class, we shouldn't look at history. We should look at history, but we shouldn't necessarily believe history. We must not, you know, we should try to do what we can to adjust it on a forward-looking basis. Now, what about covariances? Those are very mysterious. Correlations, those are very mysterious. But what they were doing is not that mysterious. What they were doing was betting systematically on one attribute of securities. They were betting long the illiquid on illiquid assets, and they were betting short on liquid assets. So there's this one attribute of securities which they pick out and they bet on that one attribute systematically, and they leverage. Now, whenever you bet systematically on one attribute, you can bet your life that somewhere along the way, nature is going to give you a kick, and I can't say where on television, on camera, for that. And what happened to them was that Russia defaulted, and everybody wanted liquid assets, and they were wiped out. Of course, the government, they were too big to fail. So, I mean, since they were huge players, the Fed came in and, you know, gave them 10 cents on the dollar to be nice kids. But any small investor who decided he should go down and do day trading, the government doesn't come in and give him 10 cents on the dollar. Let me give you another example, which we may not have time to, you know, to show ever, but it's a fun example. My son is a lawyer, big lawyer, and he's head of Markowitz something in Portland, Oregon, and he's does civil cases. And he said the other year ago, Dad, I have a story to tell you. When we saw each other socially, he said, one of my clients lost $90 million out of $100 million of his client's funds. His client was an Indian reservation. This was, you know, the gambling money, 2-3 months worth of gambling money. They want. I asked him, how did he lose $90 million? And he said, well, they wanted 22%, I think. He said, on their money. And he said, that's hard to do. That's risky. He said, no, other tribe is getting 22% of their money. We want 22% on our money. So he put them in as diversified a portfolio as he could of travel-related luxury investments like resorts and fancy golf clubs. And then 9/11 happened, and nobody traveled, and and the properties weren't worth 10 cents on the dollar. So the Indian tribe took the client to court, to arbitration, and the expert witnesses for the Indian, on behalf of the Indian tribe, each of them got on the stand and said, Harry Markowitz would have diversified the portfolio, and the three arbitrators would look over at my son, who just sat there. I mean, they knew who my son was, and like, well, it's my turn. And then when it was his turn, his expert witness said, well, they wanted 22% of the money, and this is how you got 22% of the money, and they stuck their neck out and they got it chopped off. So my son's client won the arbitration case. But as I tell my class when I give this as an example, they had bet systematically. They had stuck their neck out. They had betted systematically on a risk factor which happened then. It had never happened before. It may never happen again. But they have they bet on a risk factor. They stuck their neck out and they had it chopped off. Now, I have an interesting statistic. I'm a theoretician, so I don't do many statistics. But I have one interesting statistic. There must be hundreds of people every year that figure if they get the right formula or the right plan and they leverage enough, they will become very, very rich. Now, my interesting statistic is, they will become richer than Warren Buffett. And my interesting statistic is there may be people richer than Warren Buffett, but they didn't get it by leveraging, some cockamamie scheme. Warren Buffett in particular got rich by going long and holding for a decade. And if he likes it, he holds for another decade. So the people who bet systematically on some attribute or in some other way have a surefire scheme and then leverage it, they all get chopped down. They all get their neck cut off.
They all get it in the end.
They all get it in the end, or the neck, or wherever. Hang on, what time? Oh, it's not. Oh,
Not quite 2:30. I think
oh,
I've
yeah.
got time to squeeze in
yeah.
one more.
The thing is that I've turned off my.
Oh, right.
Yeah, you're right. So I've turned off my alarm.
I got your
Okay, right,
decaf on my
right.
mind, don't worry.
Decaf on my mind.
So in high school, I've read a little bit about your
Yeah, I understand.
biography, and I've learned that you're interested in physics and philosophy. So after completing your bachelor's degree at the University of Chicago, what made you decide to focus on economics?
When I was in high school, I was interested in. I read science, especially astronomy, at a non-technical level, popular level, like the ABC of relativity kind of thing. I read philosophy I read the original, texts of the philosophers. I was particularly fascinated by Hume, who said, even though I release, which I won't do, this this cell phone, 100 times, and every time it falls to the ground, that doesn't give me a necessary proof that it won't go up. Or to put it another way, just because Newton's law of universal gravity checked out in thousands and thousands of experiments and applications, that doesn't mean that somebody, some curly-headed Jewish guy isn't going to come along and get a better theory. I was interested, for example, in Descartes. I was just fascinated by Descartes saying he'd expected in his first meditation. He says, "I planned to do this for some time now, but let me just clear my mind, darken the room, just look at this one candle and ask, what do I really know?" And after deciding this isn't necessarily solid and so, he finally concluded, the only thing I know is I think, and therefore I am. Anyway, so I was very interested in. I was a nerd before it became fashionable to be a nerd. So I was interested in what do we know and how do we know it. Now, when I went to the University of Chicago, they said you don't have. At that time they were doing. They gave a 2-year PhD, Bachelor of Philosophy, and there were survey courses, and there was a survey course in the physical sciences, and they said, well, you don't have to take the course in the physical sciences. You know as much, you already know as much as we are going to teach in this survey course. So I went. So when it was time to decide what department I would go into, I forgot I really love astronomy, especially in physics. And I had taken a course, in this survey of the social sciences. I had a course in economics, which had both this math and empirical side, and it was very interesting. And I said, okay, I'll be an economist. I mean, it wasn't a long-standing objective of mine to save the world. In fact, it hasn't been an objective of mine to save the world until this last crisis, in which I decided, the world needs savings, and maybe I have something to say about it. But anyway, it wasn't a long-standing objective of mine to save the world by going into economics. It was just a last-minute decision, 5-minute decision.
Phew, he's just like the rest of us.
Yeah.
Should we take a break? It's 23 minutes after.
Yeah. Okay.
Okay.
Take 5, take 10. You know where the bathroom is?
So, camera is running. This.
Since we can cut and
Oh, yeah.
paste, doesn't make any difference if I'm in the middle of something when the tape runs out. So
Right.
I will be non-mindful. The next event, the only thing that is important next is my driver, not Paul, but his substitute will be downstairs at 5:30. He's got a fare out to LAX.
Oh, Paul does?
Yeah, Paul does. So he has this other guy pick me up, and Paul can be flexible, but this other guy doesn't. Isn't a regular client of mine. Yeah, that's fine. The time flies. It's almost 3 o'clock already.
That's true. Well,
Okay, camera's running.
all right, here we go again. So how do you think the market downturn has affected DC plans and their participants? Do you think it's driven more participants to seek advice?
That's a question of fact that I don't know. I would hope that it has. I'll give you a piece of information, an anecdote, a true anecdote, relevant anecdote from a prior crisis, and maybe this will have a similar effect. One of my clients, it was named at that time, now it's merged into something else, Frontier Analytics. I have several clients in addition to Guided Choice. It did efficient frontiers for small, for financial planners, for people who couldn't do them for themselves. One of the people who it had an advisory board. I was on the advisory board. Another person on the advisory board was a guy named Roger Gibson, who was a financial planner. He's also written a book about how the benefits of diversification. And we had a conversation late in the 1990s, and he said he was losing clients because his diversified portfolios were not going up as fast as the market. Oh, hi, Midge. I'm in the middle of an interview. Hello? I think I've turned it off. Yeah.
No, it's not off.
Okay, turn up. There's a button on top.
It'll go off when it's
Okay, it makes no difference. I'll just say, I'll pick up at the point. We're on? So I was on the advisory board of this outfit, Frontier Analytics, as was Roger Gibson. Roger Gibson is a financial advisor, but he has also written a book on financial advice and so on. So he was also one of the members of the advisory board. And late in the 1990s, he said he was losing clients because his diversified portfolios were not going up as fast as the market was going up. Like, for example, he had people in REITs, real estate investment trusts, and they were going down. And here, everything was going up, and except his REITs were going down. And he said, well, they're they're not correlated with the market. That's important. Well, they didn't care whether they're correlated with the market or not. They wanted portfolios that would go up as fast as their neighbors. So after 2000, after March 2000, maybe some meeting in 2001, I don't remember exact date. I asked him, well, Roger, did the people who left you come back? And he said, well, if they leave you, they never come back. But the ones that stayed are very happy, and they brought their friends. Now, I would hope the same experience will happen in this. If we get out the word, it's not just all mathematical finance. There's a difference between portfolio theory, which typically puts people into 60-40 mixes of stocks versus bonds, or maybe 70-30 stocks versus bonds, but doesn't leverage tremendously like some of these financially engineered products, or doesn't encourage people to buy and sell and buy and sell, and that makes their broker rich but them no richer. The folks who are 60-40, let's suppose somebody has 600,000 in stocks and 400,000 in bonds, and that 600,000 has fallen to 400,000. Well, that's hurt, that's painful. But if they just hang in there and keep investing, keep putting the money in, they will do well. I'll give you a couple of statistics. I'm not good at remembering statistics, but since I've been giving these kinds of interviews quite frequently lately, I've picked up a couple of numbers. One was the S&P 500 from 1950, roughly when I started investing, to the present. So this would be, if you were born in 1950, I won't ask you when you were born, but if you were born in 1950 and your granddad put $1,000 into the S&P 500, the S&P 500 then was 19, and now it's 900. I mean, you got to look at it was 920 when the day began or something like that, and who knows whether it went up or down, 900. The 900 looks a lot smaller than the 1,200, 1,300, 1,400, whatever it was that we had not long ago, but it's a lot bigger than 19, so you just hang in there. Now that's without dividends reinvest. That's just a price series. Then I had I was party to a presentation. I'm not sure I could pronounce the guy's name correctly, so I won't. I said, "Can I quote you?" And he said, "Yes." Now I can't even. His last name is Cotton, and he's also in our business. He said, his chart said, let's look at the horrible 1970s. And I think his data went from 68 to 78. Well, let's look at a decade that was really not like the 29 through 33, but nothing ever got off the ground. It was sort of our dead decade. Now, he said, if you look at just the price series, the S&P over this particular decade ended up approximately where it started. So you got zero on your money. But if you had saved your dividends, you would have ended up with, you started with $100, you ended up with $150. So, that isn't a great growth rate, but still, it's better to have $150 in the bank than $100 in the bank after, when you come to retirement time. And if you had continued to put $1 a month, in addition to your $100, you would end up with 300, and I can't remember, 325, 350. So that's a bad decade. Now, of course, if you stuck it out through the Reagan years, and through the first the Hillary Clinton years and the first Bush years, and even on to here, but things haven't been good lately. But if you just hang in there for the long run, you will just do fine. I don't remember the question, but that was the answer to something.
No, they're all good answers.
Thank you.
I think it's interesting what the idea of keeping this long-term perspective and sort of a steady head about investors, on investors. How do you blend behavioral economics with finance? Do you think financial advisors can help participants, keep from making irrational decisions?
Now, since we're in the guided choice conference room, I probably shouldn't keep plugging any of my other clients, but I have another client called Bellator, I'll tell you, who's different business. We're in the 401k advisory business. They are in the servicing of financial advisors business. And I'm on their advisory board. Here I'm almost a full-time employee, but I'm every Thursday. If when I go downstairs to get coffee, the lady down there knows it's Thursday. Anyway, so but there I meet them. I meet once a quarter, and most of the places I work for old friends like Ming Wong and Ganlin Shu. They used to work for me at Daiwa, and I consult for them. But this particular contact, this particular customer, came. The person who talked me in is a guy by the name of Mayor Statman, who is one of the bigwigs in behavioral finance, and he at this other place that I was on the advisory board, the Frontier Analytics, which became part of SunGuard. We read a paper that said you can merge the behaviorist terminology and viewpoint with the mean variance frontier apparatus fairly well. What you do is you let people talk in terms of, I'll call them buckets. The behaviorists, Mayor Statman will say they're not buckets, they're mental accounts. But you let, okay, buckets, And one bucket is what you're doing to prevent yourself from becoming a bag lady. It's your safety net. And then there's a bucket which, if all goes well, you become very, very rich. But it's just a small, you're not taking a cockamamie scheme and leveraging it. You're just, taking a little bit of your money and betting big. And then in between, you can do long run kinds of things. And if you do it right, you can put together a portfolio, which is in 3 buckets. And you talk to the customer in terms of the 3 buckets. But the portfolio as a whole is almost mean variance efficient. It almost gives you maximum return for given risk or minimum risk for given return. So Mayor Statman reminded me of that article, and I said, I know it quite. Said, did you ever read this article? I said, yes, of course I read this article. And so we're doing that. We're, the rules of the game there are that we can explore things theoretically to our heart's content, and then the outfit, the Bellator, will make such use of our insights as commercially, to their advantage. So there is no conflict. It always was true that the portfolio said, let's think about the portfolios. Portfolio theory said, let's think about the portfolio as a whole, and there's downside possibilities and upside possibilities and return in the long run. And it summarized it in terms of risk and return, mean and variance on the portfolio as a whole. And that's perfectly consistent with saying, well, we have some investments there that are defensive, and we have some investments there which are, reasonably offensive, and then we have some, if you want, some emerging markets which go way up, and then way down. And on the average, you'll do well if things go as they have been. So implicit, there are always those motivations in this diversified portfolio, having to face many contingencies. But now we can talk to the clients in their terms, thanks to cooperation with the behavioral folks. Cut.
Sure.
I'm sorry that I have to keep. You don't mind if I have other clients? No. Yes, no, the guy. It's not like having other women or anything like that.
I'm not worried about that.
I can turn the camera off for that part.
No, thanks. Can I tell? Is the camera on?
It is. Would you
Okay.
like me to turn it off?
I ha-
I'm going to have to turn it off at 5 minutes.
Oh yes, yeah, okay.
I thought you were gonna
Yeah,
say
that's fine.
that.
I heard a
Let's
joke
do another
yesterday.
5-minute.
Okay,
All right.
peace.
Here's the question we talked about earlier. Should portfolio risk preferences be based on participants' time horizon, or how valid is it to weight an investor's personal risk preference in selecting investments?
What we try to do at Guided Choice is to let the client see what the probability distribution of how much she or he will have at retirement is, things about the probability distribution. And how they react to that, which certainly has to do with their risk preferences. We make recommendations to the client, and we make slightly different recommendations, somewhat different recommendations as to the risk class they should be in, depending on whether they're a long way from retirement or a short way from retirement. But this also has to depend on what their wealth is. We have two products. One product we've had for a long time. It's called guided savings, and it has to do with how you save between now and your retirement. Then we have another product which is, the technical boys say it's ready to market, but the marketing folks up in San Jose haven't brought any clients in yet, but we're ready to market. And it's called guided spending, how you should spend after retirement, or even, you know, how you should start spending even before retirement. At retirement time, you have to ask, should I annuitize some of my savings? Because I have a longevity risk. You certainly don't want to necessarily be in a less risky asset class than you were at the age of 21, because you may be a lot richer at the age of 65 than you were at 21. And it might be perfectly reasonable for you to keep a reasonable portion in equities so that your children and your grandchildren and your great-grandchildren won't have all their legacy eaten up by inflation. So it's a complex kind of question. Like many complex kind of questions, it can benefit from analytic techniques, from analysis. The analysis should take into account that there's randomness with respect to stock market returns. We know perfectly well now. If anybody had forgotten that, they know it now. There's randomness with respect to longevity. It's a complex set of decision variables that you can choose among. And it's not obvious that, it's not obvious what's the right answer. And analysis helps. Now, sometimes I've been mean-mouthing analysis and saying, well, if you've got a scheme, remember there's a certain possibility that that scheme may not work out, and don't leverage it. But that doesn't mean that I don't think that analytic techniques and a little judgment and so on can't help you think through what is a good decision with respect to annuitizing, with respect to what risk class you should be in at age 70 as compared to age 30, and so on.
Good timing. Let's